We don't expect the Fed to cut next year at all. But that said, we're in the same book in terms of the fact that we do think the U.S. economy is gradually slowing down. Quite apart from the stock market, we've seen, for example, that the higher income sector in terms of luxury sales have actually come off quite a bit. You look at luxury goods stocks, for example, they've come off quite a lot. And the high income earners are in fact form the bulk of consumers in the United States in terms of consumption power. And we are seeing a gradual weakening on that side. So I think all in all, the signs are increasing that the economy, the momentum is gradually slowing down.
So, and I suppose because I finally found a little bit of a tipping point in between expectations, I've got to ask then, if the Fed, in your view, because you're expecting the 2 cuts to come through, obviously that could easily have a requisite impact, and it doesn't allow, for example, the bond markets to take things of their own volition. But if we were to take what you're suggesting in terms of the Fed not cutting, so maintaining policy, would that also be with the expectation that all other measures that they have introduced would be continued, whether it be quantitative tightening, whether it be backstopping the banks, which they still are considerably doing so in terms of taking on at par their significant losses in some respects. Would all of these things continue? Because then that opens up the door to they're allowing the bond markets in some respects to tighten conditions for them, and then you potentially run the risk that if you let a centralized authority start to run the markets, that they're going to run it and they can lead to some extreme results in terms of the velocity of movement and just what they intend on doing.
Yes, I think in terms of the Fed's policy settings currently, I think they'll let them run through at least the first half of next year. In terms of how the bond market reacts, I think the fact that once the market gets a clearer picture that the economy is gradually slowing down, and indeed that the labor market weakens more discernibly in the next few months, I think that will definitely cap any upside potential in bond yields. And also in terms of the impact on nominal bond yields, inflation expectations should then be pulled towards the lower end of what we've been seeing, or at least kept at the lower end. And so that will restrain bond yields from going up a lot further from here. But as I said, we were not expecting the Fed to cut next year. So we don't really expect a big tumble in bond yields going forward. But it will restrain, the slowdown will restrain bond yields from rising much further.